Okay, I know a few guys are running a bit late because I think the schedule did say 8 p.m. So we are a bit early. It's just that we've had a few technical difficulties in the past few sessions. So just to avoid that, would rather start early, right? And guys can just join in around 8 p.m. when things get really exciting. So I don't want anyone to miss all the exciting stuff that we actually have. As I said, the next few sessions are going to have some very impactful knowledge for your future trading, and if you follow it right, as I'm certain that most of you guys will, then it will be a very the rest of 2019, I can say, will bring more smiles than frowns to you. And so we're just going to basically go in with a very simple but very efficient concept that is around how markets actually behave around liquidity areas. Okay, so I'm not quite certain if you guys have been like with a few sessions with me in the advanced fund, then you know a bit about liquidity and the importance of liquidity and how liquidity influences these price movements on a day-to-day basis. So with that being said, liquidity is the name of the game, right? It's the name of the game within the FX market, within the commodity market, the vanilla options, whatever market that you can actually think of, and as well with the tech market, for example. I mean, if, for example, I have extremely expensive laptops, right? It's a basic supply and demand scenario. If I have very expensive laptops that sell for like 25 grand, 25,000 rand, and I mean, there's no one looking to buy them for 25 gorillas, right? What would basically happen is I would have to either lower my prices, okay, or quit selling them and sell something else, sell something cheaper. So in essence, if you take those same 25,000 rand laptops and place them, or you place your shop, for example, in Balito, you go into Sandton and you actually place it there, then you're putting them within a market of people that can then actually afford those laptops. So in a sense, that's generally what liquidity is, because it's about finding where smart money can actually execute their orders. Okay, so in a general sense, I mean, most people who have been trading for a while do understand and do know for a fact that most obvious places where stop losses are going to be at the previous day's high, the previous day's low, right? Previous month high, previous month's low, previous week's high, previous week's low. So all of those obvious areas provide some very, very critical areas of liquidity. Okay, so in a sense, then what we're going to try to do is extract a few pips, right, on a day-to-day basis based off that particular concept. So what we first need to do then is to then take a basket of currencies, right, and we just put them side by side, okay, and then we start looking on, let's say, for example, on a 1 hour time frame or on the 4 hour time frame, and we generally get an idea of, right, here's the high of the week and there's the low of the week, and what did the market do the previous week, right? Because I know a lot of guys are going to start thinking that that is back testing. That's really not back testing. It's just having an idea of how the structure actually is. Because once you go into backtesting, you really necessarily have to actually place the trades, right? You need to go through a simulation of placing the trade. Because if you're going to do it like the conventional way, people look back, I mean, your eyes are going to see what they want to see. They're going to see your strategy working far better than it actually will. Okay? And every time, let's say, for example, your eyes sees a trade that would probably not have worked, you're going to be like, nah, I wouldn't have taken that one because, I mean, I would have been smart enough to see that that wasn't going to work out, so I'm not going to trade that one. So it's generally the same thing that happens when people start to backtest oscillators like RSI or the TDI or whatever the case may be. They just look at the overbought and oversold signal, so they ignore the times that the trade or the strategy was wrong, and they affirm the times that the strategy was right. So they get very, I can say, in a sense, inaccurate data. So what you want to do is to have unbiased, accurate data that's going to provide you with a blueprint for executing your strategy on a day-to-day basis, week to week, month to month, where you can generate consistent profits based off data that you know works on a consistent basis. So I would think then with the basic exercise itself is, let's say you're looking at previous week's high, previous week's low. Let's just make an assumption that this USD CAD is in a downtrend, right? It's in a downward spiral. And as a general rule, I mean, the markets will trend probably less than 30% of the time. Markets will trend about 30 less percent of the time and will generally range about 70% of the time. I mean, that has been debated and I can say discussed as to why that is so, but I think one of the most prevalent cases or the most prevalent arguments about that is that the markets have become choppy due to systems trading or algorithmic trading or trading robots, whatever you want to call them, and therefore breakout trading is not as effective as it used to be. Okay. So that's why if you're using a breakout type of strategy, as a few people do, and it actually does work, only with a decent risk reward ratio. If you're using a breakout strategy with a inverse risk reward ratio, meaning, let's say, for example, you're risking 5 pips to make 1 pip, then a negative risk reward ratio, then you're definitely going to be a loser in the long run. Okay. Even if you use good money management, 0.5% risk, 1/4% risk. No, I'm not going to trade 0.01. I'm going to trade 0.00001. It doesn't matter. The only thing that's going to happen is you're going to drain your account very slowly, as opposed to one person blowing it. Okay. So what you need to do is firstly refine and look at the areas of liquidity where the market is most active around. Okay. Now that is easily visible on the charts. Okay. We have information on the chart. I mean, if we didn't have the charts to look back into, I think we'd have a problem. But we do have the advantage of going back into charts, looking at how the markets have behaved, and then from there, making a reasonable assumption that the market could possibly do the same thing the next couple of times, right? With, let's say, a relatively high amount of accuracy. You don't need to be 100% accurate. You don't even need to be 60, even 50% accurate. Okay. But obviously, it's the retail trader way, where they fall for the trap of trying to be right most of the time, as opposed to making money. Because that's all that really matters. It's the making of the money. We don't do this for fun. Right. So if we look back then, we can see, right, this is on the 4-hour time frame, right? So on the 4-hour time frame, we're looking at the Euro CAD. So the week of the 28th May, right, there's a high and there is the low of the week, right? So this is the low of the week and that is the high of the week. Okay. And if you notice what happened right above that swing high of the week, and if you extend this low over here and that low of the week, the market just swung just below it. And then again, for that week, you see market came in, boom, just above that high of the week and swung the opposite direction. Okay. Now, generally, the market will have sort of like these swings, right? These swings are influenced by where the smart money is actually going, right? Because it's all about liquidity at the end of the day, nothing more, nothing less. Where the money is, that's where smart money is, right? That's where you want to be. So in that particular way, then we're looking for shorting opportunities, for example, right above the previous week's high, and buying opportunities just below the previous week's low. Okay. Now that is the most basic way to think about things in terms of trading ranging markets, because in a sense, most of the time you're going to be trading ranging markets because the market ranges so much. It's actually quite incredible because we have this thing that a market is really trending, but it's actually moving sideways. For example, this. Right, this is all sideways movement. Okay, technically this is all sideways movement. Right, and then you have, let's say, one full week of drop, and then the market goes back into sideways movement. But in between that sideways up and down movement, we have these swing highs. Okay, you would have a high of the week, for example, previous week, and then the market would spike above it, then pull back in, and then move higher, let's say to another level, and then the market will pull back down again. See, then the market goes into this choppy sideways range, right? We'll move up a bit, and then boom, hit the swing low right below the previous week's low, and then boom, hit the high, go right above there, and come back in. Now, sometimes I usually say that some brokers might have this as a high that's tags 1522. Okay, but that's all. It all depends on how the market behaves around that swing high point, right? So with time, we'll be able to spot and identify which trade setup has the higher probability. Obviously, we're not just going to look at the previous day's high or the previous day's low and just make an assumption that, okay, every time it goes above previous day's high, I sell. Every time it goes below previous day's low, I buy. So that's not what we're going to be going with, although that could possibly work. I mean, you never know with the markets. However, we want to increase the probability of the actual trade working out by including a few more elements to the setup itself. Okay. So you can see the market shifted away to the downside, and then it came back in, right? Now, this is not a characteristic of a trending market, right? Trending market will make lower lows or higher highs. I mean, this pulls down 100 pips, pulls back another 80 pips. Okay, this is really choppy, sideways movement. It's very difficult to predict where the next couple of 100 or 200 or 300 pips is actually going to come in, because you're barely getting to 100 pips within, let's say, the space of 6 or 7 weeks. Now, if you're trying to get 200 to 300 pips on that particular currency pair while it's in sideways consolidation, then you're going to have problems. Okay, so let's say we took this ranging area over here. Okay, and the only thing we were looking at or focusing on is the previous week's high or the previous week's low. That's what we're going to sell. That's what we're going to buy. Let's say we're going to throw in a 50 pip stop, and we're going to have a, let's say, 100 pip take profit, for example. Okay, just want to see the ranges, because that always has to depend on the currency pair itself. Okay, let's just say 25 pip stop and 50 pip take profit. Okay, so there's a high established, boom, the market came up, probably stopped you out on 50 pips on that one, and we'll move back in. Okay, now those numbers, you need to always keep count of those particular numbers. Okay, because in time, once we get to the relevant re-entry prices, because if you get stopped out at a certain key level and the market moves against you a certain amount of pips, there is a point at which you are either wrong, okay, or the market is just trying to flush your stop out. So in which case you can re-enter at the next available level. So I mean, in later sessions, we'll go through that, and hopefully that concept will help you avoid being right on the direction, but still losing money and also missing out on money, which is sort of like a double blow. So, and then the market moved to the downside. You can see, nice swing to the low side. Okay, and there we had the low of the week, boom, and there was the high of the week. Okay, so the range was set. Right, the market came in, swing low, not once, but twice, and shifted away to the upside. Okay, so if you had then bought that, I mean, you would have at least made that 100 pips. Okay, let's say you lost 50 pips on this one, you would have at least made 100 pips. This is just without anything else, like just blindly following the signal. Okay, swing low as well. Let's see, boom. Okay, depending on your broker here, you probably would have gotten a fill on the pending order. Okay, market swung low, below, just below, or just tag the previous week's low, and swings to the upside. I mean, also, if you got the entry there, I mean, I think even here you would have gotten at least 100 pips on the swing to the upside. Okay. Like guys, now don't just go and then start taking trades based off this. Okay, there's a lot more that we need to cover with this. As well, here, boom, see the market will activated your sell stop at the previous week's high, okay, and a rise of about 60, 70 pips on this one. I doubt even your re-entry would have actually worked on this one. On this one, definitely would have worked, but I doubt on this one. So you would have had like your first clean loss on this one, definitely. And you'd wait for the next opportunity, right? Okay. So, and then the swing low would basically be this one now, and the swing high would be the one right above. And you do this with a decent risk reward, even if you're winning 50% of your trades. So if you're winning about 50% of your trades, okay, not sure about this one, probably would have survived the 50 pip drop. If you had a 50 pip stop rather, you would have survived the drop, and at most like 60 plus pips. Okay, this one definitely out. I think even the re-entry, definitely even the re-entry would have been stopped out on this one. So you'd have about 2 out of 6. So the reason why then we have this sort of like focus on these liquidity areas is simply because that's where smart money is looking to come in and to get out. And with the market, any type of market, you're looking to come in and get out where the big players are coming in and also getting out. Okay, now there are very subtle ways that you can spot this. I can say manipulation around these liquidity points or liquidity areas, but it takes a bit of practice for you to do so. Okay, so with some testing, right, with some simulation, with some forward runs as well, you'll be able to spot them on the weekly. So this has been the weekly. We're just looking at the previous week's high and we're looking at the previous week's low. Now this is a concept that I've used for quite some time, especially on the indices. Okay, I remember catching my biggest trade on the German DAX using exactly this methodology. Uh, it's just that obviously with the indices, in a general sense, if things are stable, the economy is good, then they're going to trend upwards. Okay, because I mean, you're looking at the top 20 or your top 30 or your top 100 US or German or British companies. So those are generally going to perform well. And obviously, if a company is not performing well, they drop out of that basket of indices that creates that index. So it's much more simpler because you have this one directional bias when it comes to, let's say, trading an index rather, of, let's say, the US tech, right? Because we know, okay, the US is doing pretty well, unless obviously the president says something, then okay, there could be a crash. You know how that guy is. But in a general sense, you know that those are stable markets and generally they're going to be moving upwards. So it's much easier. You're just looking at the previous thing. You can, I mean, with an index, you can generally just trade that way. You're looking for the previous swing low or previous days low or weeks low, and you just have your pending order. I mean, it's a really lazy way to trade, but when you do get it right, I mean, the market just flies. There are a few times you might get it wrong 2 or 3 or 4 times, but the time that you do get it right, I mean, it more than pays for the other times. So you should definitely try that. I think on the we had a very decent example of what I was talking about. Not quite sure which market it was. I think it might have been the USD CAD. Okay, let's just go back there. We're just gonna go with the weekly for now, and then I'll show you guys like the previous day's high, the previous day's low, how to then put the concept along with other elements in order for you to increase the probability of the actual trade working out. Okay, so let's just start here. Right, this is fine. Okay, so we've established that this is a low of the previous week, right? And this is the high. Okay. So in this particular example, you can see had activation, boom, market was activated just below that swing low because that's where the liquidity is, right? You also have the benefit of having the moving averages just below that low. Okay, that also adds a really good layer of, I can say, confluence, because in the end, you want to have a few things that actually tell you that this trade is going to work out. Right? You don't just want to have one. You want to have a few things that tell you that the trade is a really decent one. So the previous week, boom, there's a high, low, spike below that low, boom, market moves opposite direction, swing high. Right. Same thing happens here. This is a high. Now these are the more subtle ones that I actually spoke about. Those subtle nuances to the rule where a high is established, let's say, on Friday evening. And then that swing low just or that swing high comes in during the Asian session, boom, hits that high, and the market starts moving away. And obviously with this, we love seeing this. Okay, we love seeing this. So in time, you'll be able to spot what the main reason or the very main, I can say, possible reason why the market would actually do or behave that type of way around that area. Okay, so you can see that the market would have swung low. And now this is just basically using this, right? There's a potential, I can say about 100 pips on this move, okay? And on the downside, there's another potential 100 pips. Boom, got that 100 pips. Okay, swing low on the downside. You mark off your swing low or the previous week's low rather. Get a 50 pip stop in. I mean, this is basically lazy people's way of trading. There you have your 50 pip stop. Boom, and that swing high. If you're trading it, you probably would have gotten out at break even or minus 10, 15 pips. But I mean, you already collected 200 pips on the move. And also, once you're done with this week, then you can see, right, there's one more week, okay? There's a swing low, and there's a swing high. right? Market comes in, swing low, activates just below that previous week's low. Okay, I'm sure you guys are starting to see this. This is too easy to spot. Okay, there's the week's high. Market swings just above it, right? Swings to the downside. Previous week's low, boom, same thing happens. I mean, over here, this range, you could have traded this range and made a really, really, really good profit of it just by simply trading without this. Now, I'm not saying this is the way you can actually trade it, because you like to have a bit of confluence. Well, it's essential that you do have a bit of confluence when it comes to your trade setups. But you can also use this type of method just to sort of like practice and get accustomed to the behavior. Because one thing that we are looking for is the actual behavior around these key points. Right. So we got a couple of hits there, and like I said before, the markets are mostly moving sideways. I mean, we get the illusion that the market is trending. Right? We can look at markets that have been moving today because we usually so stuck in and glued in, let's say, to the 30-minute time frame. Right? If you look at the 30-minute time frame right now, you would believe that the USD CAD is in an uptrend, right? But if you go onto your daily time frame, you'll see that okay, this market looks to be, it has been trending down. Okay, especially on the daily. I mean, it's been on a free fall. On a 4-hour time frame, obviously, it would be in a downtrend as well. Market has been firmly below the moving average, which means it's in downward trending territory. So it's in a sell-off. But since we get so stuck into the 15-minute time frame or the 5-minute time frame or the 10-minute time frame, okay, then we start to believe that that's the actual trend. Right? So, like I said before, this is a very important part that you need to understand. Whether you use it as a way to actually get into trades, or you use it as a way to get out of trades, or you use it as a way to stay out of trades altogether, it's very important because as you go back, right, that's what you need to do. So tonight, I mean, the main thing that you need to start doing is going back, let's say on the 4-hour time frame, and start looking at what we spoke about, right? Just start looking. Just, I mean, you don't have to write anything down. Just start highlighting. Right, this was this week's high, and that was this week's low. Right, then mark that off and see how the market behaves around that area. Okay, like okay, market swung to the upside, boom, activated. We've activated the sell stop, right, and pop to the downside and establish this low. Now you have your new high and you have a new low. There we go. There's a swing high and there's a swing low. So the following week, the market pops right above that swing high, moves to the downside, pops below this low over here, but we've probably used this previous week's low as our low. Would have taken a bit of hit, but eventually the market would have behaved in a way that we would have actually liked. Okay. So out of those, let's say 4 or 5 trade setups that actually developed, you have about 3 or 4 that actually did work out, and the one that didn't, you're gonna lose minimal pips. Right, you're gonna lose minimal pips because even if you do take this swing high and you just have a lazy way of looking at things, I mean, you lost about 50 pips. But if you had 50, then like I said, there's a way for you to re-enter into the market and it was probably paid out. If you lose more than 70 pips, then okay, even the re-entry wouldn't have worked. But if it's around 50 pips, then re-entry definitely would have worked. But with time, I'll show you guys how to do that. Right. For now, just go back. Ideally, go into markets, well, any type of market, because even if you go into the USD, the euro dollar, you'll be able to see the same patterns, right? If the market isn't trending all that much, I mean, if it isn't ranging all that much, let's say it's in the rare instance where it's actually trending, then the concept won't be that visible, but you'll still see hints of it. See this high, right? Previous week's high, spike above it, and then the market moves to the low. And these subtle ones, these are the ones I like a lot. The high is established towards the last day of the trading week, which is Friday evening, and then the market retests that high around Asian session. Okay, so those are the ones that I particularly like, and there's ones that are really extreme where you can see quite clearly that there was nothing but manipulation here. You can see the high of the week that was established there, the market swung to the downside and just boom, up, swing high, pulls the market back in. Right. So you guys have any questions so far? Okay. Any questions, guys? All right. So I think I might have come across an indicator that does highlight the previous week's high for you and the previous week's low. So when you're going through your charts, you can do it much quicker, as opposed to you having to throw in that previous high and the previous low all the time. Okay. So this is sort of like the first element that we're going to need with what we're going to be doing, right? Like I said, this is not the way to just go out and trade with, right? It's a concept that you can use because it is very effective, but it's a concept that you can use that can help you guide you into the right type of trades. Okay. All right, guys. Any questions? No questions whatsoever. Okay. Right then, guys. If there are no questions, I will be around on WhatsApp, probably for the next, say, hour or so. Yeah, because right now it's about 25 past 8. Yeah, for the next hour or so, I should be around. So you guys can just drop me your questions and I'll be able to answer those. And I will be searching for that indicator. And if I do find it, I doubt I can send it through on WhatsApp. I'll just take everyone's email address, or you can drop me a text on Telegram, and then I'll send it through to you there. Because I think the file format you can't send on WhatsApp. I'll rather do Telegram. Okay. So with less than 3 minutes left, well, less than 4 minutes left, we'll be calling it an evening, guys. I'd like to thank everyone for coming through tonight. I do believe the session was recorded, right? I'll upload it and then I'll share it in the WhatsApp group. So if you did miss the first few minutes of the session, then you'll be able um, to revisit all the concepts that we went through earlier. Right, so this has been me, and guys, and hope you guys enjoy the rest of the evening. Cheers.